Hi there, Rick Edelman here. I'm really glad to have you on the program with us today. This is what's next for blockchain and digital assets in 2022 and beyond. And we're going to cover a lot of your questions as well, many of which you've already submitted. Very happy to welcome onto the program Matt Kuhnke. Matt is the digital assets research analyst for Global X ETFs. Matt, thanks so much for joining us on this event.
Yeah, thanks for having me, Rick.
And Matt, tell us, your background obviously is long in this industry, former alternative investment fund due diligence at JP Morgan. You've got your CFA, of course, which is probably the most important designation in asset management. You can follow Matt at mkuhnke _GX. Tell us a little bit, Matt, about Global X ETFs. This is one of the largest ETF providers in the country. Tell us about Global X.
Yeah, so Global X is a Manhattan-based ETF provider, and we are currently managing about $43 billion across more than 90 ETFs today. We have over 100 professionals working at Global X, not just in New York City, but more and more overseas as well, Canada, Latin America, Europe. We're predominantly known as the thematic ETF provider, as you can see on this slide, the orange bar here. Just in terms of AUM, and that's going to be the primary focus today as we discuss blockchain and digital assets. But we are also known for our income suite and some other offerings as well.
And so let's just really jump right into this here. We've got hundreds and hundreds of financial advisors who are tuning into this conversation. And we asked everybody to provide us questions that you have about this subject of blockchain and digital assets. And we got an awful lot of questions. Thank you very much for all those. And we're going to tackle some of your questions here during the program, not only the ones you pre-submitted, but you have the opportunity to send in your questions right now. And as we go through this conversation, just use the Q&A section. Just hit that button on your Zoom and type in your question, and we'll do our best to get to as many of those during the conversation as well. And Matt, one of the fascinating things, I guess it's not so fascinating. I've been involved in the digital asset space since 2012. I know you've been involved for a very long time as well. I sometimes forget that not everybody has been involved in this area for as long and aren't as familiar. And so a lot of the questions I got when we asked registrants to this event to send in questions in advance, we got questions that were very, very basic. So we're going to start there. We will get to more complex and topical, meaning what's going on right now, what's happening in 2022 and beyond. We'll certainly cover all that as well today. But I want to start at the beginning because there are so many folks who are watching this webinar who really need us to take it from ground from 0.0. And so that's the very first question that we got was, here's what this advisor said: I don't know where to start.
So how would you answer that, Matt? What would you say to a financial advisor who's new to blockchain and digital assets? Where should they begin?
Yeah, I think I'm a big fan of just getting to the meat of it and the first real application of blockchain technology in the Bitcoin white paper. So I think that's a great starting point, just reading through that and trying to get an understanding and the grasp of it. And then naturally, the whole ethos of blockchain and digital assets is open source, open everything. So there are really a lot of great ways, from Medium newsletters to individual protocol discords that you can go and check out. And communities are generally very open and willing to share information in this space. So I think that's just getting your feet wet and getting involved in the communities is a great way to better understand the technology.
Is there a particular resource that you're a fan of?
In terms of, yeah, I'm a big fan of the Mastering Bitcoin textbook. I think of that as the sort of the gold standard in terms of trying to understand the actual technology here. Andreas is a great educator on the topic of blockchains and the underlying tech. So big fan of his. And then as well, just a multitude of different newsletters. Masari does a great newsletter on crypto and everything digital assets. Anything by a lot of the great hedge funds and asset managers out there. Multicoin Capital produces great content.
So I think that's a really good point, is that the folks who are offering products and services in this space are also good at providing education about it. And of course, we have a lot of resources here at DAC FP to help you as well. How would you, advisors are also equally curious as to how do you talk about this with consumers? So how would you answer the question to a client, what is blockchain? How does it work?
Yeah, I mean, I would just go at basic principles. A blockchain ultimately is just a peer-to-peer shared distributed ledger. So it's a ledger that everyone has a copy of, as opposed to a typical accounting system where a centralized entity like a bank unilaterally maintains control of that ledger and makes adjustments. So in a blockchain system, adjustments to account balances are systematically made by each user maintaining their own copy of the ledger, following a set of protocol rules. So basically just running software on their end.
Well, describe the whole point of this. I mean, if this is different from the traditional way we are dealing with ledgers, with banks, and just records of deposits and expenses, what's the point of it? Why do we need it? How is it better than what we're doing already?
Yeah, I think one example is just the four of us here dialed into this call. I think, if we wanted to transact between each other and send money around, we don't need to pay a third-party bank to come in and facilitate that for us. We can come to decentralized consensus amongst us, and you can cut down on middleman costs that way. Additionally, in some other areas where you might not have the trusted institutions that some people believe we have in the US, being able to remove or disintermediate the trust structure of a bank or a federal government from the money is a pretty impressive characteristic.
So is this only something that is relevant in the banking system? Is it just financial services?
No, it can be. I think that's it's thought of that way by some people as Bitcoin being the first application, really. But today there's smart contract platforms on blockchains that allow for decentralized execution of agreements, right? So it can be utilized for supply chain management. It can be utilized to get instantaneous loans. There's basically a multitude of different use cases beyond just payments and finance that can be automated through smart contracts that can facilitate what normally a third-party trusted institution would be able to do for you.
Elaborate for us on what you mean by smart contracts.
Yeah, so this is basically just programmable money that says, a good example would just be like, let's say we wanted to bet on the outcome of a sports game. We can have programmable money where I say, if this event happens, if the New York Knicks win tonight, I pay Rick $10, and if not, Rick pays me $10. Yeah, so just programmable money where you can basically code the money to certain outcomes.
Because it's something I don't think we think about very often. If I send you money, it's because I need to send you the money, but I only want you to get it if you do something for me in return. Mm-hmm. And that's what this whole concept of smart money and programmable money is all about, smart contracts. And so it's a totally new and different thing that just opens up the ability to do business in a way that we never able to do it before. That makes a lot of sense, and I think people can justify pretty easily their level of excitement about blockchain technology. It lets us do business faster because we don't need an intermediary. It's therefore cheaper because we don't have the bank's expenses in between. The blockchain technology is super safe from a cryptographic perspective. Bitcoin blockchain's never been hacked. So it's faster, cheaper, and safer. It's easy to get excited about blockchain. But why then is there so much enthusiasm for Bitcoin? Why is, talk about the difference between blockchain and Bitcoin, and should we be as enthused about Bitcoin as we are about blockchain?
Yeah, I mean, I'm a big Bitcoin fan, but they are fundamentally different things in a sense, right? Blockchain is the technology stack underneath Bitcoin, where Bitcoin is one mere application of blockchain technology applied to payments. But why should you be excited about Bitcoin specifically? I think it's the first successful form of decentralized currency that has a programmatically defined monetary policy, is not tied to the whims of any government wanting to inflate their currency. And that may be overlooked by some individuals in the US, where they say, hey, we trust the banks, we trust our government, we think it's run by individuals who are good stewards of our capital. Some people may believe that, some people may not after the financial crisis and the recent monetary and fiscal stimulus of COVID. But when you go into emerging market economies and other countries where they may be under a dictatorship, or in some scenarios, quite frankly, the currency's been inflated to nearly zero multiple times in some of these individuals' lifetimes. The idea of having this decentralized currency that can't be inflated away by a government, the government cannot control it, this is a global monetary network, is really valuable. And I think that's shown by the data of the percentage of users of cryptocurrency if you look at the top 15 countries with the highest cryptocurrency usage, 14 of those 15 are emerging or frontier economies. So I think they can very clearly appreciate the value of this technology a lot easier than some in developed market economies can.
So Bitcoin was the first. It was invented back in 2009, and it is by far the largest of all the digital coins. It has a little more than half of the total market share, even though there are, 10,000 plus coins out there now. Bitcoin is by far the single largest. But is it all just about Bitcoin? Do none of the other coins have any relevancy or value?
Oh, not at all today. There's so much more beyond Bitcoin today, and that's what we were discussing a little bit earlier. Platforms like Ethereum and other competing layer one smart contract platforms. There were a lot of the use cases that we discussed earlier, like supply chain, things like ticketing and elections, and the governance of companies could be run through these blockchains. All those applications would be built on a smart contract platform such as Ethereum, which is, as you know, the second largest blockchain today. But there's also many other competitors to Ethereum that are trying to do similar things, such as Solana, Avalanche, et cetera, et cetera.
Well, let's just give one illustration. You mentioned smart contracts, programmable money, and that's really what Ethereum is all about, right? I mean, that's Bitcoin. I like to refer to Bitcoin as dumb money. If I send you Bitcoin, you get it. That's all there is to it. And you get it virtually immediately. But Ethereum allows you to program that distribution of money so that you don't get it necessarily right away. You only get it if there's a condition. So if Bitcoin is dumb money, Ethereum is smart money, right?
Yeah, absolutely. And it allows for so many applications, even just beyond like what you'd think of in a traditional finance sense of like pure money. It allows you to embed money into applications.
And so does that suggest that there's more business utility for something like Ethereum than for Bitcoin?
I would say yes. That's my personal opinion. I think others would argue the other side. I believe there's more business utility, certainly from programmable money and smart contracts, than a payment network like Bitcoin.
And that raises one of the key questions, doesn't it? That you said it really well, Matt, that other people will argue that Bitcoin is a bigger deal than Ethereum. And it is a big, healthy debate. I guess it's kind of like Coke versus Pepsi, Microsoft versus Apple. And there's a lot of debate as to who's the favored product. So that is one of the most common questions we got from folks in advance of this event was, what are the primary methods for gaining exposure into this space? So would you recommend that somebody buy Bitcoin, or they buy Ethereum, or they buy a little bit of both, and along with some other stuff? I mean, how should people proceed if they're trying to engage in this asset class with their investment strategy?
Yeah, and without giving any particular direct investment advice, I would say I think if you were to take an indexing sort of approach, right, like Bitcoin and Ethereum are a very large part of the digital assets market cap, it would probably be prudent to own them in some way, shape, or form if you want exposure to digital assets. But in terms of how you would actually go about doing that, I think there's a few different ways to get exposure to this theme and this ecosystem today. I think the direct and most intuitive approach is going to crypto platforms like Coinbase, Gemini, Kraken, et cetera. These are just cryptocurrency exchanges, and you can just directly purchase cryptocurrency from them, linking a bank account, similar to if you were funding a Vanguard account to buy stocks. It's as simple as that. The next consideration is a little bit beyond the scope of this conversation, but it sort of falls into, do you want to then custody your own assets, or do you want them to custody them for you? And if you want to custody your own assets, you're going to have to go the next level beyond and look into software wallets or buying a hardware wallet to keep them safe. But you can also just leave them with these exchanges. Next, and another approach that really Global X, that's where our business is today, is investing in the equities that are beneficiaries of blockchain technology. So these are really the picks and shovels of blockchain technology, if you will. The companies that operate in the space primarily are people like hardware manufacturers for Bitcoin mining ASICs and hosting facility providers. Then you have the actual Bitcoin miners themselves, the ones actually utilizing the ASICs. And then you have primarily the crypto exchanges, the Coinbases, the Voyagers of the world. And we actually have two products that invest in these equity securities, the Global X Blockchain ETF, BKCH, and the Global X Blockchain and Bitcoin Strategy ETF, BITS. The latter also owns Bitcoin futures. So one's a pure play on the picks and shovels with entirely on the picks and shovels. Another one's a blended approach on the picks and shovels and the futures. But so blockchain ETFs are another way to do it. And then lastly, I would say is depending on if you're accredited or not, there's also private fund structures, hedge funds, venture capital funds that invest in these technologies as well.
Right, so you just rattled off a really long list, a really good list of all the different ways that people can invest, as financial advisors can help their clients invest in this space. I want to go through them a little bit in greater detail for folks. And one of the set that you mentioned, such as Riot Blockchain, Marathon Digital, are Bitcoin miners. These are publicly traded stocks of companies whose sole business is mining for Bitcoin. And people have heard that phrase, Bitcoin mining. I think a lot of folks don't understand what that is. So give us a little riff on Bitcoin mining.
Yeah, and I'm going to probably go a little technical, and then I'm going to give you a very simple example of how I think about it. So at a high level, Bitcoin mining is the process of utilizing electricity to secure the network and create blocks on the blockchain. And given the fact that blocks are cryptographically connected into the chain, and given that you need a verifiably large amount of electricity to create a new block in the chain, these features in tandem are what make it prohibitively expensive to try to attack the network and change contents of old blocks. So mining is a security property of the Bitcoin network. But how it actually works in practice is miners are pooling together pending transactions into something called a candidate block. And these are blocks of potential transactions or potential blocks of transactions that they're hoping to add to the blockchain. And they take the contents of this candidate block and they continuously iterate it through a cryptographic hash function, searching for a really small output. And that's the technical component that we're going to just leave it at that. And then I'm going to give you a very, very high level example of what that kind of means in practice. So stepping back, think of like every miner is basically having like a random number generator. Let's say they can just click this random number generator as fast as their hardware allows them to. So some people are competing with better hardware than others. But let's just, for this example, say between 1 and 1 million, this number generator will shoot out. Then when they're calculating as quickly as they can, the first miner, let's say, to calculate a number less than 100, it wins. So given it's a totally random process and it's between 1 and 1 million, it should take 10,000 computations on average to get you less than 100. So when you start dealing with finding very small numbers out of a very, very large opportunity set, much larger than 1 million in Bitcoin mining, it becomes very clear in the long run that the first miner to find the winning number put in a lot of electricity and computational power to find it. And it's that process right there that secures the blockchain and protects it from attacks against the network trying to reorganize historical blocks. That's what gives it the immutability property that people always say with blockchain.
And then the whole point of this is that the miners get compensated for doing all that work.
Exactly. I left that off. I was gonna say they are financially incentivized. Currently today, they get 6.25 Bitcoin per block found, plus all the transaction fees inside of the block. That's usually around like 2% of that. So just a small little sweetener on top. And then that number does get halved every 4 years with the Bitcoin halving process. But just for a little context of how profitable this is today for these businesses, some of these top miners like Bitcoin, or like Riot and Marathon, as you mentioned, are mining Bitcoin at like $5,000 to $6,000 in cost today. And obviously Bitcoin was over 60,000. Today it's still north of 40,000. So it's just an incredibly high margin business right now.
So in other words, these companies, for every Bitcoin they mine, and as you said, if it takes them time to produce the Bitcoin, to do this verification of the data, they get 6.25 Bitcoin. Bitcoins are worth over $40,000. So they're making $250,000 every time they succeed in doing this. But they're not spending $250,000 to go through that process. They're only spending about $25,000 to go through the process, and they're rewarded with $250,000. That's a 10x return on their money. That's a pretty good business. And this is why there's excitement about investing, doing one of two things: either be your own Bitcoin miner or buy stock in a company that does Bitcoin mining. And those are two of the most fundamental ways to invest in this ecosystem. But let me mention another way. What we've described, Bitcoin mining, is, go back to the California gold rush. miners. Everybody went, go west, young man was the slogan, and everybody ran into San Francisco to go into the mountains and dig for gold, and they were gold miners, and they were hoping that they would succeed and find that gold. Levi Strauss had a different attitude. He went to California, but not to dig for gold, but to sell blue jeans to the gold miners. And he, the story goes, made more money than any gold miner did, because whether or not they found gold, he sold them clothing. So that's what we now know as the picks and shovels route. Don't try to buy Bitcoin. Don't try to mine for Bitcoin. Invest in the companies that are facilitating the mining operations. So talk about the notion of the picks and shovels approach to investing in this asset class.
Yeah, that's certainly a portion of our ETF and other blockchain ETFs out there is, you have people that need to buy hardware to mine Bitcoin. You have players like Canaan that are producing the ASIC manufacturer or the ASIC hardware. So it's application specific integrated circuits. These are pieces of hardware that are very technically and specifically designed to solve the cryptographic hash function that Bitcoin is based on as quickly as possible. So as long as you think people are going to continue to be attracted to this gold rush of where there's such a high margin business in mining, you can profit by buying the manufacturers that actually produce the chips that they need to purchase in order to mine Bitcoin.
So you mentioned the two ETFs that Global X offers. Provide again the ticker symbols, the names of those funds, the ticker symbols, and the difference between them.
Yeah, so it's the Global X Blockchain ETF, that's BKCH, and the Global X Blockchain and Bitcoin Strategy ETF, that's BITS. And the difference between them is BKCH is entirely invested in blockchain equities. So again, the manufacturers of Bitcoin mining hardware, the cryptocurrency exchanges, and the cryptocurrency miners predominantly. And then BITS.
So these are basically the picks and shovels route.
Yes. And then BITS is similar. It's investing in all those same companies with roughly half of its exposure. And the other half of the exposure is investing in Bitcoin futures. So it's going to give you a slightly higher correlation to Bitcoin itself. Yes.
And so let's talk about Bitcoin futures, because this is a whole different breed. There are now some ETFs that are exclusively Bitcoin futures. Global X chose not to do that for a pretty good reason. So talk about what it means to invest in Bitcoin futures, which is different from investing in Bitcoin.
Yeah, a Bitcoin futures contract, as the name implies, you're betting on the price of Bitcoin at a future date. But there have been some drawbacks. So today, you are not able to buy spot Bitcoin directly through a regulated ETF vehicle. So if you want a pure play exposure to Bitcoin in a regulated vehicle, Bitcoin futures are sort of your next best thing that you can access today. There are some negatives to it in the fact that they typically do trade at a premium due to the market being in a state of contango where the futures price is higher than the spot price. So given it's a derivative contract based on a price in the future, you have to do something called rolling the futures, where you buy a later dated future contract. And when it approaches expiry, if you want to maintain exposure to the Bitcoin future, you're going to need to sell the near-term contract and buy a later dated contract. So when that curve and that term structure is a steepened point, you can roll down, and that can have a little bit of a headwind cost relative to the price of Bitcoin. But we think of Bitcoin futures as being an efficient way to get exposure in a regulated vehicle in a way that's very simple for advisors, and that they don't have to deal with going on the blockchain and dealing with custody of private keys that we were discussing earlier. If you go on Coinbase and buy Bitcoin and you want to take it offline and secure it yourself, there are risks to that. So Bitcoin futures are a nice, easy way to do it in a regulated vehicle, but there are some drawbacks as well.
So it's important that you understand these issues. You mentioned contango. Another piece of jargon is backwardation, which we're not going to get into here. We've got an article on this subject. If you would like to read it at DAC-FP, you're welcome to do that. The point is that there are different ways you can engage in this asset class, and you need to be familiar with the different approaches. And one key that I think is really advantageous is using the ETF model, because we're all familiar with ETFs. They're very low cost, they're very transparent. You can include them easily in your brokerage account, your diversified portfolio. They're simple and easy to deal with, and that's why Global X has championed the ETF world in that space. You're not buying Bitcoin, you're providing ETFs that provide exposure to that. So I think it does make a lot of sense in that regard. But you also said something really interesting about Bitcoin futures, that the price of the futures contracts might be higher than the price of Bitcoin itself. And that raises the question about valuation. This is a very common conversation where people are just scratching their heads saying, how on earth do I determine the value of Bitcoin in the first place? I mean, it's not a company. There are no employees. It's not a product. There's no revenue. There's no profit. How do I gauge the value of Bitcoin? How do you answer that, Matt?
Yeah, I mean, I think there's a few different approaches. It's not as concrete as going and doing a very theoretically defined discounted cash flow model and valuing a security. I think about it predominantly as a more easily transferable version of gold. Like that's, at least in my head, the number one valuation model for me. So if you think about the gold market versus the Bitcoin market, gold somewhere north of 10 trillion, Bitcoin less than 2 now. And if you're able to do sort of like a volatility adjustment, if you think about traditional portfolio analysis and Sharpe ratios and efficient frontiers, Bitcoin should, like, you would need to adjust for the volatility differential between Bitcoin and gold. But I think you can take like a market set of like the opportunity of being up there with gold and potentially even larger, because gold is something that people buy and it's harder for them to liquidate. They probably have to liquidate it at a discount if they want to, if they're holding physical gold. Or Bitcoin is so easily transferable and fungible and liquid that it potentially could have a larger opportunity set than just gold. Other approaches, people look at like stock to flow models, trying to look at like the emission schedule of new Bitcoin being created versus the total amount in existence at that point in time. And there's a handful of different approaches that other people do, trying to look at the amount of transactions happening on the Bitcoin blockchain. As you know, blockchains are very transparent and open, and you can go look on blockchain.com or any other blockchain analytics service and see the amount of transactions occurring. So people try to get valuations that way as well, but I tend to think about it in terms of gold. That's how I try to framework it.
And I think that that's a pretty good analogy, because gold has many of the similar features that I mentioned. It's not a company. There's no employees. There's no revenue or profits, and yet people have owned that for thousands of years as a store of value, an inflation hedge, as the belief that its price will rise over time. There's limited supply. A lot of those seem to have similarity to Bitcoin. There's even been a book written called Bitcoin, referring to Bitcoin as digital gold, along those lines. What I find is the big challenge is that if you do try to apply a lot of the traditional economic metrics, you mentioned stock to flow, for example. If you try to apply those metrics to Bitcoin, your head kind of explodes. I mean, look at Jamie Dimon. When he says Bitcoin is worthless, it's because he's using those economic models and trying to apply them to Bitcoin, which doesn't make any sense because there are no profits or revenues, there's no product, et cetera. So I agree with you, Matt, that the simple solution to me is to acknowledge that we don't know what the value of Bitcoin is, but we can all agree that there's a price. And the price is determined very simply by supply and demand. Bitcoin has a fixed supply. 21 million will ever be manufactured or invented through the Bitcoin blockchain. That's it, 21 million. Of those, we've got about 18.5 million have been mined so far, which means as more and more people want to buy it, the supply is fixed, and that would suggest that there needs to be an increase in price. So if you are looking at the price performance, it's all relationship between buyers and sellers, right? It's really that simple, isn't it?
Yeah, it's a large network of individuals that believe it has value, and that's the value to a lot of currencies in the world. That's the value to gold and the vast majority of gold's valuation, right? It's people that believe it has value, and if there's a lot of people that are going to pay for it, somebody I can come in there and keep buying up if it keeps falling, and there's people that are going to buy the dips in Bitcoin because they believe it has value.
So I want to give you two contrasting statistics because they seem to be incongruent. And I want you to explain, if you can, the reason for this. The first statistic is that we now have roughly 300 million people around the world who own Bitcoin. That's out of a population of about 7 billion. So it's still very, very small. Less than 5% of the population owns Bitcoin. Compare this, for example, to Facebook, where we have about 3 billion users. 3 billion people have a Facebook account worldwide. Go back 15 or 20 years to when Facebook had 300 million accounts, not 3 billion, but only 1/10 as many. Look at the price of Facebook way back when. So clearly, as the number of users grew tenfold from 300 million to 3 billion, the value of Facebook grew much more than tenfold. It grew more than 100-fold. And this is simply that the value of the network grows much faster than the network itself does. So that would argue, my first set of statistics, that with only 300 million people owning Bitcoin, as the number of people around the world grows in ownership from 600 million to 1 billion to 2 billion, that the price of Bitcoin should grow exponentially. That's the thing, right? That's one set of statistics. But let me give you the other side. In the past few months, the price of Bitcoin has fallen sharply. It's down 30 or 40%. How do we reconcile these two sets of statistics? Well, how do you explain the recent decline in Bitcoin and therefore all of the related investments associated with it?
Yeah, I mean, I don't think it's too different than any other asset market that everyone on this call has experience investing in, right? If Apple falls 30% over the course of a 2-month period, it isn't necessarily because the fundamentals have deteriorated by 30% and they're going to earn 30% less future cash flows into perpetuity. There is more volatility in price than fundamental valuations. And I think what you're describing there with Metcalfe's law and the value of a network being proportional to the number of users, that's more of a fundamental, in my view, the fundamental strength of the network, where the actual Bitcoin price, I mean, it's a market of buyers and sellers. If people get bearish overnight, and that has that sort of psychological aspect of more and more sellers in the short run, I think you can just have more outsized moves in price over short periods of time that aren't necessarily tied to fundamentals. It doesn't mean we lost 30% of our Bitcoin users overnight when we lost that price difference.
And so I think this is a reinforcement of the age-old statement that we give as financial advisors to clients all the time. We need to recognize the risks associated with this. You need to maintain a long-term perspective by asking yourself the basic question: do you think there's long-term potential for this, and not allow periodic or momentary declines in pricing to, dissuade you from your long-term view? I guess that's what it comes down to, isn't it?
Yeah, I completely agree. You need to have thick skin in crypto.
We've had 5 times the price of crypto has fallen more than 50% in the last 12 years. And most people figure that's going to happen again one day. So thick skin, I think, is a good way to refer to it, Matt. So let me shift the conversation then. Given all of that, given the fact this is still relatively new, it's still emerging, it's still maturing. We've come a long way in the last 12 years, but it's still relatively new. What excites you the most about this asset class?
Yeah, it's really hard for me to narrow that down to one thing because there's so many fascinating things. Maybe I'll just give a few. I think payments is fascinating. I'll give a quick example about El Salvador in just a moment. But I would say the 5 most exciting things: payments, DeFi, NFTs, DAOs, and scaling. So let me spend, this might take 3-4 minutes, but let me just give you one on each of these, because I think these are fascinating areas. So just first on payments, I won't spend too much on El Salvador, but there's a great YouTube video. It's like 3 minutes by, I'm blanking on the name now, but a Bitcoin magazine reporter, when he was on the ground in El Salvador just after they made it legal tender, and he had a friend send him $20 in Bitcoin to El Salvador. This friend ended up paying $20.20 in Bitcoin based off scanning a QR code that his friend on the ground in El Salvador sent to him, and a $20 bill came out of the ATM in El Salvador a minute later. So that's a 1% fee to send Bitcoin basically instantaneously across borders. You compare that versus the time and the dollar it costs to use a traditional remittance provider. It's truly incredible there. So I think that's a really interesting one that I think we're going to see more and more of.
Well, I want to make sure people do understand the cost savings there. The typical process of sending money from one country to another, such as to Western Union or a bank, is 6.5% in fees and takes 5 days. So in your example, it happened in 10 seconds for 1%. This is revolutionary.
Yeah, it's pretty incredible. So just moving on to the next one. So DeFi. So that's the acronym for decentralized finance, and that's what you mentioned earlier of disintermediating banks. At a high level, you can just think of this as automated financial services through a permissionless protocol like Ethereum. Through smart contracts, you can automate financial services. One example is utilizing an application like Aave or Compound. If I had $100,000 in Bitcoin, that doesn't necessarily mean I can get an immediate loan on that asset from a bank. It would be very hard to convince them that I want a loan on my Bitcoin. And you'd have to deal with, one, the bank's working hours, the 9 to 5 on non-bank holidays, credit checks, etc. I can get an instantaneous asset-backed loan on Aave utilizing a permissionless protocol immediately, any time of the day. So I think that's fascinating in DeFi. NFTs, or non-fungible tokens, are digital tokens representing a non-fungible item, largely today in digital art, but we're really at the cutting edge on this one. I think the use cases for NFTs will be very different in a few years. And it's one of those things where I don't know exactly how it's going to play out because it's so revolutionary. But they could be used in terms of like creating digital twins from a real world asset. One good example of the actual NFT project that's out today in terms of real world use cases is Gary Vaynerchuk's VFriends. It's one of the largest NFT collections. It's an NFT collection that empowers creators to create their own monetizable ecosystem of fans. These fans want direct access to the individual direct access to the individual's content, and they don't want to be like gated by a distribution platform. So Gary Vaynerchuk's platform lets them buy NFTs. They give them access to his events, his conferences, etc. And you're basically paying directly with just removing the intermediary that would normally be in between you. So I think there's just a lot of really interesting ways that NFTs will be used. And I should state that while you're buying that, you also it's a marketplace that has a value that you can list it for sale. So if you
let me do one of the latest examples that was just in the news this week. A restaurant is going to open in New York City, and the only way you can go into the restaurant is if you buy the restaurant's tokens, their NFTs, and so it becomes a membership. So the restaurant's only open to its members. The members have to own the NFT. And once they buy the NFT, and 1,500 people have already done this, raising $1.5 million for the restaurant, they now can sell that token to other people. So as the restaurant gets more and more popular, the tokens become more and more valuable. So this creates a community of folks that love this seafood restaurant.
And to just make one, so as I mentioned, I don't know how this is going to play out. It's very cutting edge. One thing I do know that I find incredibly fascinating about NFTs is that restaurant. I mean, even before saying that restaurant, there's so many markets out there where a rare release comes out and you have so many scalpers trying to buy it and then trying to just resell it immediately. NFTs allow these creators of either content or actual physical material to maintain a percentage of the returns from secondary market returns after the fact. They could code into the NFT, the creator of the content or material gets 5% of all secondary market sales after the fact. So when you have people coming in and scalping new releases and then reselling them at a 10x profit, you can keep a lot more of the P&L in-house through the use of NFTs. And I find that fascinating. That's one thing I'm confident of in NFTs. And then I guess just moving on to the last two things I'll briefly hit on are DAOs, which are decentralized autonomous organizations. These represent a new, more democratic form of governance around company building. DAOs can effectively be a new company structure where the control of the DAO is governed by real-time voting that's tied to the token ownership of the DAO itself. So think of you're basically buying into a token that gives you a real-time vote into whatever operation it is. It could be a company, it could be a crowd fundraising event. I think the most prominent example is Constitution DAO, which I'm sure many people saw the headlines for. Basically, in a week, a few individuals created a DAO, a decentralized organization, raised $40 million to buy the last privately held copy of the Constitution. They unfortunately got outbid by Ken Griffin and Citadel. But like owning these tokens of the DAO, and this one unique case would have basically just given you the ability to vote on which academic institutions the Constitution would have been held at, who would maintain custody of the Constitution and protect it from sort of natural elements and things like that. So I find DAO is really fascinating. It's a very broad topic, and that's just one really unique example. And there's plenty more. And then just the last thing I'll say is just on blockchain scaling. This is probably a little too much for the scope of this conversation today, but in order to go from the next million users to the next billion users, we're going to need to scale platforms like Ethereum and other smart contract platforms. So using techniques like optimistic rollup and zero knowledge rollup, those are things that are going to be very important in the future. And I'd highly recommend looking into them if you're interested in how blockchains will scale in the future, because those are some of the most prominent ways.
And then there's the latest, which is the metaverse. What's fascinating here, and I know we're throwing out a lot of terms and jargon, NFTs, DeFi, DAOs, metaverse. Here's the fascinating thing about all of that. 10 months ago, nobody ever heard of an NFT. It wasn't until after Beeple, an artist living in the Carolinas, sold a piece of digital art at Sotheby's for $69 million. That's when we all first heard about NFTs. That was 10 months ago. That was last February. Then you go back to last summer, and that's the first time you ever heard of DeFi. And then you go back to September, and that's the first time you ever heard of a DAO, a decentralized autonomous organization, when the Constitution DAO came out, as you said, to try to buy the last remaining public copy of it. You never heard of a DAO prior to September. And then last fall, you heard of the metaverse for the first time. And it's such a big deal that Facebook, Mark Zuckerberg, changed the name of the company to Meta Platforms to illustrate that it's all about the metaverse. And we heard the news this week that Microsoft has purchased Activision so that it can get a huge foothold into the metaverse. These terms are emerging with such speed that it's, on the one hand, kind of hard to keep up. On the other hand, kind of demonstrating the importance of engaging in this with a portion of the portfolio. So that if you're not going to become the expert of this and devoting 20 or 50 hours a week to it, then just invest your money in a fund that is being run by a manager who is spending 50 hours a week in this, so that you can just ride the coattails. You don't have to become the expert. And it's the same thing with your stock portfolio. You don't need to be a stock picker. Just put your money into a stock fund and let the fund take care of it for you. This is really not very different. But having said all that, Matt, there are some big, broad concerns that people have raised that I'd like you to address about the appropriateness or the adverse impact of Bitcoin and digital assets. Two of them are the most prominent. Number one is, and we'll tackle these one at a time, but I just want to mention them. The first is illicit criminal activity, money laundering, ransomware, terrorist financing, tax evasion. The second one is the environment. So talk first about illegal activity. Does Bitcoin facilitate criminal behavior?
Of course, in some way, but no, the answer is it's an unfair generalization. Blockchains at their core are open, transparent databases, right? As I mentioned, blockchain.com is a Bitcoin block explorer. You can go see every transaction that's ever occurred on the Bitcoin network. There's blockchain analytic companies and forensic companies, the most prominent of them being Chainalysis. They just actually in the last week or two released their 2021 crypto crime report, indicating that the percentage of blockchain transactions that were utilized for crime fell to just 0.15%. And that's versus, I think, 3% 2 or 3 years back. So it's clearly trending downward. And I think due to this generalization, a lot of people thought they were making anonymous transactions on blockchains. And then now I think it's a lot more clear that these are open. And if you're a criminal trying to use anonymous internet money, Bitcoin's not the thing for you. It's substantially less crime being happened on the Bitcoin network than you're seeing in cash. The UN estimates money laundering is 3% of global GDP annually, which is substantially higher than that 0.15% previously mentioned.
And second, the environment. A lot of folks are fearful that Bitcoin is bad for the environment, that the energy consumption is just waste.
Yeah, so a few points there. That argument is almost entirely related to proof of work mining. And if you're to look at smart contract platforms, which are becoming a very large portion of the ecosystem today, if you look at the top 50 cryptocurrencies, Bitcoin's one of the very few in there remaining that's like proof of work mining. So it does take a lot of electricity to secure the Bitcoin network, but that's not necessarily true for all of crypto. So just that is a starting point. Then I want to go to some of the, it's more of a nuanced argument here. You see headlines that are very much Bitcoin's burning down the environment. Somebody even tweeted that people are freezing in New York City this week because of Bitcoin, and they're just very sensationalist headlines. But in the reality, there's some pros to Bitcoin. Bitcoin's one of the very few large electricity consumers that can turn off immediately. Other data centers, have multiple backups and resiliency planning because they cannot go offline. So if you think about Bitcoin in terms of incentivizing green energy and renewable energy, Bitcoin's largest cost in terms of mining Bitcoin by far is the electricity consumption. So they're economically incentivized to seek out the lowest cost electricity, which tends to be renewables. So over 50% of Bitcoin mining occurs on renewable energy today. And it actually incentivizes more renewables due to that fact that previously mentioned about turning on and off, being modular. So renewables, think about the main ones today in the US, we have wind and solar. The wind only blows sometimes, the sun only shines sometimes. So you have these non-stationary power loads. And Bitcoin can incentivize them to invest more in these non-stationary loads because they can turn on the miners, consume this excess energy, and as soon as that renewable energy drops or there's more demand for that renewable energy, they can just shut off. And they can purchase long-term power agreements, like this is very prominent in Texas, where they have long-term power agreements with the state's deregulated electricity company. And then when the government or when the electricity grid needs more electricity, these companies can just sell back their long-term power to the electricity grid, and it can actually incentivize the investment in renewables. And then just one last one to point on here that I find fascinating is there's companies that are now, because Bitcoin mining it's not, you can do it out of a cargo container. It doesn't take that much. You don't need to build something very structural into the ground. So there's examples of some Bitcoin miners co-locating on oil fields with stranded natural gas, and they're utilizing gas that would have otherwise been flared. And it's actually a net negative carbon emission in terms of using that gas to create electricity to mine Bitcoin versus having these oil fields flare the natural gas. So there are scenarios like that where that's a green version of Bitcoin in my mind. Sure, it still creates carbon, but it's net negative relative to what would have happened.
Let me mention one other aspect of this. Everything you said is spot on. Is that there's more than one way to create digital assets. Bitcoin mining is one way. The mining function is known as proof of work, and that's one way that you create digital assets. But there's another way called proof of stake, and not every coin engages in the Bitcoin method. Many of them use this other method. Ethereum, for example, is going to be converting to the proof of stake method this summer. So if you don't like the idea of the mining function because of the energy usage, whether it's green or otherwise, then don't buy Bitcoin, buy Ethereum or the other coins that use the proof of stake model. And that way you don't have to worry about it. But I'll even take it a step further than that. The energy consumption is predominantly involved in the creation of Bitcoin. It's the mining, it's those cryptographic calculations that Matt mentioned earlier. It's sort of like saying it takes an incredible amount of energy to manufacture a car. And it's true. Think about the energy that Ford and General Motors uses to build a car. So if it bothers you, then don't buy a new car. Buy a used car. It's already in the marketplace, and it won't take a lot of energy for you to buy a used car. So instead of mining for Bitcoin, go buy another piece of Bitcoin that's already been mined, that's already in the marketplace. And this way, you don't have to worry about the incredible energy consumption associated with it. So lots of different ways that you can examine this situation. But the bottom line is, as Matt said, the the stories are a bit overblown as to the adverse impact from an environmental perspective. We've got a few minutes left, and some of the folks are asking about regulation. Is there regulation? Is it possible that the regulators are going to do something that could undermine or interfere with the marketplace of this? We don't have a Bitcoin ETF, for example. So talk about the regulatory outlook for all of this.
Yeah, the regulatory part obviously varies a lot by region. And in the US, it's tough because there isn't a ton of federal regulation. A lot of it's done at the state level where different states have different regulations for crypto. New York, for example, having the BIT license, it's the most restrictive state to access crypto in the United States. But in terms of where a lot of the focus is today, in terms of near term, where there could be regulatory risks, I would say are more on the exchange side of crypto. The SEC and Gensler have come out and stated they think a lot of cryptocurrency exchanges may be offering unregistered securities. So I think there certainly could be risk on that side of the business. And then there's also could be risk, I think, in the stablecoin arena. So we didn't really speak about that too much, but stablecoins are basically the money market mutual fund equivalents of crypto. It's a cryptocurrency. It's based on the blockchain, but it's backed by US dollars for the most part. Some of them are algorithmic, but most of them are backed by actual US dollars. And I think that's certainly in the regulatory crosshairs as well, with the Biden administration and Gensler trying to sort of seek more power to regulate stablecoins. So I think those two are at the forefront. In terms of like Bitcoin itself, I don't foresee any new large regulatory impact to it, but you do see at times, you do see states try to ban proof of work mining, while other states are embracing it, like Texas. But nothing has really made any widespread traction so far, at least in the US.
It seems to be the attitude of regulators now, and increasingly, that they aren't trying to ban it. They're simply trying to regulate and control it, the way we do the stock market, the way we do cigarettes. We are recognizing that there's utility here, and they want to make sure there's consumer protections in place. Though we don't need to ban it to protect consumers, and so that certainly seems to be the case. And one last question, and then we're going to get to some information specific to the two ETFs you offer, because we're getting a couple of questions on that. We're going to go just a couple of minutes longer than normal because we had that tech glitch earlier on, so we'll make up the time. And the question there regarding the regulatory side, I want to ask you your prediction. Are we going to see a Bitcoin ETF approved by the SEC at some point?
My personal opinion is that we will at some point. It's hard to predict timelines, if that's next year, if that's 2025 or 2024, excuse me. I do think in the long run, Bitcoin's one of those things that every day it's still around. It's stronger than the day before. It has that sort of resiliency property, and I just think there's so much money trapped in these over-the-counter trust structures that are not the most client-friendly, consumer-friendly. In the long run, I think the SEC will get more comfortable, and they will allow it for consumer protection reasons, that they can have better protections inside of an ETF structure. But they still have their concerns today. So I don't anticipate it in the near term, but I personally, as a Bitcoin bull, I think the SEC will see the light in the long run.
Well, the joke I've often made is that the SEC has managed to say okay to a 3x inverse ETF, but they won't say yes to a Bitcoin ETF. So, go figure. We had a couple of questions from folks about the two ETFs that Global X offers, BKCH, which is essentially a picks and shovels ETF, and BITS, which also invests in Bitcoin futures. What is the cost, the annual cost of these ETFs?
Yeah, so BKCH is 50 basis points and BITS is 65 basis points.
So well under 1%, which is right in line with a typical cost of an ETF. Not a surprise there. Global X is one of the largest ETF providers and pays a lot of attention to costs. So not a surprise. And is there an account minimum?
There is not, just an ETF, just the price of an individual share. So $15 to $25, depending on the ETF. That's your account minimum, effectively.
And they're available at any brokerage firm or any financial advisor. So they're just ETFs, and ETFs are the most popular investment vehicle in the marketplace today. I think last year, investors added $1 trillion to ETFs in 2021. So it's about as friendly and familiar an investment platform as there is. And these 2 ETFs, you can learn more about them at GlobalX. And in fact, let me bring that slide up as we wind down. This is the information you saw at the beginning of our webinar on GlobalX. And you can learn all about the ETFs they offer, not just in the Bitcoin area, but in the total offerings that GlobalX offers. Matt, I want to thank you so much for joining me on the program today. It was really terrific info. I also want to mention that this June, we are going to be staging the biggest event of the year, the DAC FP Vision event. It's a 2-day event in Austin, Texas, where we will have some of the biggest experts in the blockchain and digital assets field, plus a lot of exhibitors, the companies that are bringing these products to the marketplace. You can get more information about that at DAC FP. And if you, as a financial advisor, want to be able to demonstrate to your clients that you have the fluency and knowledge you need to be able to serve them, I encourage you to obtain your certificate in blockchain and digital assets, an online self-study, self-paced course with 13 CE credits. The first half of the course is all about the technology. What is blockchain? What is Bitcoin? How does it work? The second half, all about practice management, the investment thesis, the portfolio construction, regulation, taxation, compliance, and most importantly, how to explain all this to clients. And I encourage you to order your copy of my brand new book, The Truth About Crypto, which is going to be available May 10th, published by Simon & Schuster. You can order it now from Amazon.com and your favorite bookseller. Again, Matt, thank you so much for joining us on the program today. I'm Rick Edelman with the Digital Assets Council of Financial Professionals. Thanks so much for joining us.
Yep. Thanks for having me, Rick. Appreciate it.